everybody's doing well today, and welcome to our end of the year tax planning webinar with John Rizzo and our business benchmark series. Today, we're going to have John on to talk about a number of different elements around end of the year tax planning, and the timing hopefully cannot be better because this has been a year that has not been for the faint of heart with the number of things that have been going on in our industry, as well as from the state and federal government, from different grants or funds that have been handed to childcare, as well as the kind of planning we have to get into. So with that said, let's move forward and move right ahead. All right, and our agenda today is obviously we're doing our welcome, and as part of that, what we do is we go over what we have across the top of ours or at the bottom of your screen, and you have a chat function, which the chat function will be used mainly for communication, that if you are interested in something or our marketing team wants to get an email link out to you or something of that nature, we will look to do that through the chat function. If you have a question for John or myself, please use the Q&A function. Much easier for us to respond back to everybody. We are going to be doing a few different polls, and I'm sure the restrooms are down to the left. Just kidding. Let's keep going. So in our housekeeping items, we're going to talk about is our upcoming webinars. We do have two of them right almost back to back. November 2nd, next week, we have Kathy Ligon coming, and we'll talk more about that in a second. John will be joining us on December 9th, and we'll talk about that. And then we're going to go through two of the items that have some obviously importance at this time of the year. And we'll be introducing John and going into the poll questions, and year-end tax planning will be the presentation. So let's get on with it. Upcoming webinars, this is next week on the 2nd, and we hope everybody here can join us. This is the future of your childcare business with Kathy Ligon, and it's really around elements of succession planning from the business side of it. This is really around the structures, what's your growth plan? Do you have succession and exit plans? Do you need a real estate expansion plan? How about real estate downsizing plans? So this is next week. Kathy, always a fabulous speaker. We've been very happy to have her on once before when we one of our very first sessions that we had for our pop-up executive series. So very happy to have her back. And next we have John in an upcoming session. This is our series 12, which will be on December 9th. This is the financial considerations of succession. We're not asking for everybody to succeed, obviously, out of the industry, but we thought it was timely, since Kathy was going to be talking about succession, to have John and team talk about the financial considerations around succession. They have done a fabulous job in helping organizations get up to speed to the point where they're really prepared to move forward, whether it's going to be through a sale or maybe something where you might be exiting or a partial exit, something of that nature. So again, talking about structures, the different type of vehicles in a succession, strategies, tax strategies, and different kind of ways to possibly protect your funds once you go through a succession. That is December 9th. And as a reminder for those of you out there, it is open enrollment season for a lot of you, and you're really considering what are your options for healthcare. Inspire Care 360 has, as many of you know, brought a solution out there to our industry that we haven't seen before we brought that out there. And it's a highly affordable and flexible plan called Healthy Advantage. It is affordable because for individual staff members, they can have as little as $11.50 come out of their paycheck, up to $90 for their entire family, which it gives them an awful lot of support, from $15 office visits, $15 specialist visits, and the like. It's highly affordable for owners and operators. $50 for your first 10 employees per employee, $25 after that for every additional employee. There is a 10 employee minimum, and if you are interested, talk to us and we'll tell you all about the plan. Again, highly flexible for the employees, 5 different plans they choose from. It doesn't change the employer cost. Again, there's a lot of opportunities for very inexpensive, from $1, no high deductibles or the like, no high premiums. easily implemented. It does come with your own benefit administration team from Inspire Care 360. And this is the team that works directly on site with your team on educating them on what's the difference between a major medical plan as to a regular voluntary plan, as to Healthy Advantage. What are the differences? What are the benefits? What are the detractors? And really having very candid conversations, as well as the benefit administration team helps answer ongoing questions for them and helps set up for payroll. So it's a really good addition that takes a lot of the burden off of our owners who've taken it. And again, it's ACA compliant for Part A of the Affordable Care Act, which is really the heavy duty one. And it's something that if you want to learn more about, you have that coming up, a desire to get this in. You could do it any time of year to start this off, but a lot of people are thinking about it now. And so we do need about a month and a half worth of time to get it set up, to get it implemented. So if you're interested today, please reach out to us and just send a chat saying, hey, get a hold of us, and we'll do exactly that. And then I'm looking on it, John leads our IC 360 financial experts. We have different programs working with them, really focused not only on end of the year tax planning, which we'll be talking about today, but looking at different KPIs. A number of our members and non-members actually have taken advantage of this program, and it's been a fantastic program for them. But without further ado, let's go ahead and introduce John. John, if you want to pop on here, he's going to be talking today about strategic planning and ideas, as well as timing, cash receipts and disbursements, impact on retirement contributions and vehicle purchases, as well as the critical impacts of obviously the PPP, ERC, and grant, real estate tax and deductions. So with that, let's see if John, have you joined us? There he is. How you doing, John?
Doing great. How are you? Thanks for having me.
Fantastic. Oh, love having you on here. And we've had a lot of people respond that they're thrilled to see you come on at different times. And I know it's a really busy time because of, a lot of shortages we have, but we've had a lot of people who said to us too, hey, can you guys make sure if I can't get on it to tape this and get it out? Because I think a lot of people thought this was a very important issue for right now. So thanks for coming on board.
Absolutely. Yeah, we call this, tax planning season. So the timing is perfect for this presentation today.
Well, and I know last year I sort of got so delayed that I sort of missed tax planning season, and it got a little late in the year, and you start thinking, okay, I have to do tax planning. I got it's only a week or two before the Christmas holiday. It's a little late, so you need to get ahead of it. And so right at the end of October, hopefully this is good.
Yeah, it should give you plenty of time to get things set up and execute. And, sometimes you just, you get a lot of emails with requests to, you should do this, you should do that. And you don't always realize, which ones are the important ones. Well, this is one of the important ones because it is time sensitive.
Absolutely. Well, I'll hand it over to you, and you can share your screens if you want, your slides.
Okay. Yep.
And we're seeing the notes side of it, John. There you go. Perfect.
You should have everything, right?
Yep.
All right, great. Well, thanks, Tony, and thanks everybody. And we're always excited to be here with the Inspire team and really meet with motivated business owners. That's what our firm is all about. So year-end tax planning is our presentation today. I'm the presenter. I like that you use the other picture. It makes me look a lot more tanner and younger than this one. So I appreciate that. So here's our agenda.
I do everything I can to help.
Thank you. Actually, I thought you'd have, being down in Florida, I expected more of a tan out of you. So I'm a little disappointed in that. Maybe you have to go outside after the presentation. So here's our agenda. We're going to focus on, the tax planning areas of focus, real estate. And since we actually put our original agenda together, there's been some changes in tax legislation, or proposals at least, that keep changing. We're going to touch on that. We're going to touch on actually preparing your tax plan, and then we'll open up for some Q&A at the end. All right, so tax planning areas of focus. So, what we would consider low-hanging fruit in our business, these are items that, again, like Tony mentioned, like if you're not doing these things, if you forget before the year ends to kind of pay some bills that could have helped you from a tax perspective, then you've missed it. Once the important part of tax planning is, once the clock strikes, January 1st, then you've pretty much run out of most of your options for tax planning. So that's why it's so important that you handle it now. So cash basis of accounting. So cash versus accrual. So most small businesses file their taxes on the cash basis. Actually, if you're under 25 million in revenue, you can file on the cash basis. So I'm assuming that most of our audience here is on the cash basis.
Hey, John,
And yes.
may I, just because some people I know are extremely experienced with this, some other people, this is relatively new to them. What is accrual as to a cash basis when it comes to your taxes? Some people are just probably managing the books themselves even.
Yep, of course. So cash basis is basically based on when things are paid or when money is received. So it's as simple as that. When a family pays you and you deposit that into your bank account on a cash basis, that's income. Even if they paid you early, it's still income. So it's based on when money comes in and when money goes out. Same thing when you receive a bill or an invoice. When you actually pay that invoice and record it through your books, then on the cash basis, it counts at that point in time, versus when you receive a bill that maybe relates to a future period on the accrual basis of accounting, that bill wouldn't count until the future period. So cash is basically timing of when things are paid and received. Accrual is when income is earned and expenses are incurred. It has nothing to do as to when you actually pay the bills. So yeah, that's an important note and a good question. And a lot of people just wonder at the end of the year, like, what should I be doing from a tax planning perspective? Well, if you know nothing else and you're trying to get your income down, you should pay every bill that you have and even prepay some bills, like we mentioned here, to reduce your taxable income. On the deposit side, when money's coming in, to the best that you can, you should try to delay receiving payments at the end of the year. Now, there are other factors that play into this that you have to consider, the biggest of which are tax rates. When we're expecting a higher tax rate in a subsequent year, then you may not want to do that. And you really have to look at a 2-year plan versus just this year's plan. So to go through the cash basis of accounting, reduce your taxable income by prepaying expenses. Now, the one that is most commonly prepaid is rent. And we've seen others prepay health insurance, but those are probably the two biggest that you can prepay and know, hey, you're going to pay those anyways at some point. So why not pay them now if you're trying to get your income down? If you have any bills to pay that relate to 2021 still, you shouldn't go into 2022 with an unpaid 2021 bill. So you want to pay all, again, this is all in the spirit of getting your income down. If that's your plan. Now, some clients, we try to generate income because of certain situations. They may have bought a business that year and have higher deductions. We're trying to take advantage of lower tax rates this year, higher tax rates next year. So this is really a personalized plan, but here are some kind of low-hanging fruit ideas. If you're going to pay staff bonuses, make sure you're paying before the year ends versus after the year ends. A lot pay a holiday bonus, so that you want to consider paying that before the year ends. So those are some ideas on just reducing taxable income by paying expenses. Now, you can also reduce your income by deferring cash receipts or pushing income into a future period. So most centers do collect payment before or during the week of service. So in that case, it might be difficult to hold off on recording that as income or depositing it. Sometimes it does take a little extra time to get to the bank, with traffic and other things going on. So maybe some of those deposits don't hit your bank account until January, which would be good for you. You can extend payment terms through the holidays. Now, this might not be a good business move to do, but it is a good move when we're talking about tax planning. And then maybe you wait a little bit to generate invoices and billing statements near the end of the year. Again, you don't want to jeopardize not getting paid at all by doing these things, but these are ways to push income from 2021 into 2022.
Hey,
So,
John, just
yep.
a few things that I've done in the past that I think might be helpful out there too is some of you oftentimes will get a big check in December if you're taking social service or CACFP that comes from your state or your federal government, or any kind of checks that come in that might be big. And even if you're getting any kind of subsidies or even some stabilization grants or anything that is coming in, checks you can typically hold for a few weeks to deposit, just like John is saying. And on the other hand, too, is, and if they're a big enough check, you can sometimes ask them, even though they're doing a direct deposit, to send it to you so you can hold the check to deposit it after. One other thing, though, is money oftentimes gets tight because what we're saying here, what John's saying, which is a strategy that I believe in, is go ahead and pay all your bills as much as you can, as well as future bills before the end of the year, yet don't take in your revenue. And we know sometimes margins are really thin. This is a great time with your bank to have a line of credit. I try not to use my line of credit throughout the year unless I have like a capital good purchase or something like that. But if you have a line of credit, almost every time at this time of year, I've used my line of credit where I've been able to float it because I'm paying all my expenses as much as I can before the end of the year, going into the next year. So then when all the money deposits in January, I pay off my line of credit. So just an idea, but back to you, John.
Yeah, that's a good point, Tony. We have a lot of clients that do that. Now, remember, when you're prepaying things, you're essentially just deferring your tax into the future. So you're paying bills this year that you normally would pay next year. So now you have a bigger problem next year because you don't have as many bills to pay in that subsequent year. So you gotta, we call that a deferred tax liability. That really does, it's a liability that isn't on your books, but it is one you have to be aware of. So you want to find kind of a middle ground, and that's why these tax plans are so specific to your own situation. And again, this slide is assuming we want to get your tax bill for 2021 as low as possible.
Yeah, John, as you're switching slides here, what are your thoughts regarding where taxes are going with the current administration next year? Do you think, obviously, if you have a conservative government as to more of a, liberal government, oftentimes, tax rates may be possibly going up in the future year. Do you have any feeling as to where things are going to be going next year?
We do. We actually have some slides on that. And it's not possibly, tax rates are going up. I don't see any way around it. The proposal's already in, and now both sides just need to agree to it. That's where the challenge has been. They had hoped to already have this implemented by now, and it hasn't yet, but it is coming, and we will cover that in future slides here.
Perfect.
So the opposite side of cash accounting is accrual accounting. I described it a little bit, but basically revenue is recorded when earned, not collected if you're on the accrual basis. I'd be surprised if many of you are on the accrual basis to begin with, but you may. And sometimes you may be and just don't realize you are and may want to change it. That's the good thing. You can change from one method to the other. The government allows that. In some cases, you have to apply for that change. So one indication is to look on your tax return. Typically, it's on the front page of your tax return, depending upon how you're set up, to see if you are cash or accrual. Expenses are deducted when incurred, not paid. So you have less control managing your income here. You could receive an invoice in January that related to December, and that would fall in December on an accrual basis. On a cash basis, it would fall into January when you pay it. So like I mentioned before, generally accrual, you have to use accrual if your revenue is 25 million on average over the last 3 years. I'm not assuming anyone here fits that. And your primary revenue source is the sale of inventory, which wouldn't be you. So there is a good chance you can continue on the cash basis, for a very long period of time. So I'm assuming most of you, like I said, are on the cash basis already. So we'll go to our first poll as we dig into more of these tax planning ideas. So Tony can cue that one up for us. You can see what the question is here from our end already. Do you have a 401k or a simple IRA set up for your school or business? You're on mute, Tony. You're back on mute.
Yeah, it's giving me a little challenge here. Maybe
you're good. You're good.
It wants to shut me down.
Yeah.
So so this is basically if you have for your schools, any kind of deferred compensation plan for your teachers, for your staff, or for yourself, correct, John?
Yes.
All right, and we'll go ahead and we have a few people who have answered. So let's go ahead and end the poll right now and share the results.
All right, so only only 27% actually have a retirement plan, so that's good. And you're probably wondering, why are we asking this question in a tax planning webinar? Well, the reason we're asking this question is because retirement planning is probably the most popular tax planning idea that we could give anybody and the most effective. Why is that the case? Because basically what you're doing is you're taking money out of your business and moving it into a personal retirement account for yourself. And in the transition, you're receiving a tax deduction. So funding retirement is tax deductible. So we always like this idea because you're not prepaying a vendor that's not related to you or not part of your business. We're not deferring income to another year. You're actually putting money into an account that ends up being your money. Now, there's restrictions on the use of that money and when you can use it, and there's certain penalties if you use it early. But funding a retirement plan is the most effective tax planning idea we can give you. And here are some of the different plans that exist. The most popular retirement plan out there is a 401k plan. But when you're starting your business or your business isn't, say, quite mature yet, you probably lean towards the plans on the right here, either a SEP IRA or a simple IRA. Most of you probably would go for a simple IRA. So basically a simple IRA, you are using your own money and funding that into an account. And depending upon your age, you can put close to $15,000 a year per individual into a simple. And the only requirement under a simple is that you as the business owner need to match 3 to 4% of the wages of your employees that also participate in the simple IRA. So there is a cost to the employees by funding these plans. However, it does allow the business owner to put money away for themselves. This is actually an excellent tool in recruiting. Offering this benefit to your employees is huge. And I've met too many business owners that say, oh, my business is my retirement plan. Well, you never want to rely on that because anything can happen in the market and in business and with legislation and so forth. So this is a great way to diversify your situation and have your business. Yes, that is an asset that you can utilize for retirement at some point, but it's also nice to have just an account set aside with tax deferred money that is also part of your retirement. 401k plans are basically, as your business grows, this is the plan you would choose. You can put up to $25,000 a year into a 401k plan. You can also then put a profit sharing plan in with that 401k that gets you even more money. And with these, you can add a safe harbor component that, again, that's basically a match. So with a safe harbor 401k, you have to match 3 to 4%. It's very similar to a simple, but it allows the business owner to maximize the plan without running to any of these what we call top heavy rules, where the government says, hey, it's not fair that Tony's maximizing his retirement account and the employees aren't. So in order to allow Tony to do that, they would require Tony to do this safe harbor match.
Hey, John, for these plans like a 401k safe harbor plan or the like, or even setting up a few of these other, are they really expensive to set up? And how quick can you do it?
A 401k is more expensive than a SEP or a simple. And the reason is a 401k requires that a tax return be filed each year. So for a 401k, you have to hire a plan administrator to track it and then also file that tax return. So you do have some administrative costs with a 401k, but you also can write off those costs. So that's an expense that you can write off through your business, but they are a little more expensive than a SEP or a simple. SEP IRA allows you to contribute 25%. Now, this is an employer-only funded plan. So under this plan, you can fund up to 25% of your employee's income or your income into a SEP IRA. So typically SEP IRAs are used in early stage of your business where it just may be a handful of employees and you want to maximize what you can put away for yourself as the business owner. I'd say most of our clients start with a SEP, they graduate to a simple, and then ultimately end up in a 401k. There are situations where a cash balance plan could work as well. And this is when you want to put away $100,000 to $200,000 a year for yourself, which is a great benefit. And we see that a lot in a lot of smaller medical offices, but not to say that it couldn't work in a childcare center either. So there's a lot of choices. There's a lot to analyze here. We could have an entire webinar just on these retirement plans alone. But the benefit is you make a contribution before the year ends. All that money goes to you, and it's a write-off for tax purposes. So you end up getting the tax benefit of that back. If there's any questions, you can feel free to put those in the chat too, because I know we're kind of covering a lot quickly here, especially with these types of plans. Next item relating to tax planning is acquisitions. Now we've seen a lot in your industry in the past year of business acquisition. So the timing of when you buy a center or sell your center is very important when we're talking about taxes, especially now with the changing capital gains rates that are pending. So a buyer may want to close on an acquisition before year end so you can get those deductions in, because typically when you buy a practice, you're buying equipment that you can write off immediately, and you're amortizing goodwill. Those are generally the two biggest deductions when you're acquiring a practice. Seller may want to push that transaction into a subsequent year, although this year's kind of different because we're expecting capital gains rates to go up. So this is kind of the tug of war between buyer and seller. And if you're on either side of a transaction right now, you want to make sure that you're on the right side of the timing for you. That's important due diligence that you have to do if you're in the middle of a business acquisition or a sale. How you allocate the purchase price is important too when it comes to taxes. So again, like I mentioned, assets are fully expensed when you acquire them. And then buyers generally looking for assets that are in the 5 to 7 year categories. You can write them off quicker. Anything outside of those categories takes longer to recover that cost. And then goodwill, which is, again, most transactions, the majority of the purchase price is goodwill. You're buying the name, the location, the reputation, the customer list, the employees. Those are all intangible assets that you write off over a longer period of time, 15 years. So if anyone's in the middle of a transaction, you want to make sure you're considering all these and deciding if you should close before year end or after year end. Other areas to consider and areas of focus when we're talking about tax planning is, like we talked earlier, the timing of billing and cash receipts, the timing of your expenses and your payables, vehicles. So vehicles, there's always a lot of questions around vehicles and what you can write off and what you can't write off. But the simplest way to put that is you can either use what they call the actual cost method or the mileage method. So, and what makes this all work is that you're actually using your vehicle for business. So let's say that's the assumption. You're using your vehicle for business. If you purchase a vehicle, especially a vehicle whose gross vehicle weight is 6,000 pounds or more, you can write off essentially the entire cost of that vehicle in the year of purchase, whether you finance it or not. So if you have a big income year, you probably choose that method. Now, other costs that go with the actual cost method on vehicles are your fuel, your repair, insurance, interest on a vehicle loan. All those costs would be included if you choose the actual cost method. If you choose the mileage method, that's essentially what you can write off is the miles driven for business times the IRS rate, which is kind of moved around, but it's ranged between 54 and 58 cents per mile. Most of the time, the actual cost method will get you a larger deduction, but you may not be looking for a larger deduction in a certain year and may want to choose the mileage method.
Hey, John, let me ask you a question. Oftentimes if we have multiple locations, we may have a executive director or a regional director who's going to be traveling between schools back and forth. Is there any thought if we were to lease a vehicle for that employee? Is there a financial benefit in doing that, or is it best just to reimburse them for their mileage spent?
Yeah, I think that, so whether you lease a vehicle, whether the company leases the vehicle or you reimburse them for mileage, whatever that cost is a tax deduction for the business. So I would say that's more or less a wash, and then maybe not going through the effort of leasing a vehicle makes sense. If you were to purchase a vehicle that your employee was going to use to drive around, then that probably would make more sense to do than to reimburse the employee for mileage, because now you're getting the full deduction all in 1 year. So dealerships, we get calls this time of year from clients that are literally in a dealership looking at a vehicle, looking at the weight and the price, and asking us to run an analysis if they should lease, if they should buy, if they should do nothing. So again, this is time sensitive as well. The next item is another popular one where you could put family members on your payroll. And the reason you'd want to do this, there's 2 reasons. If you have a family member, say a son or a daughter that's in a lower tax bracket than you, that's a good way to shift income away from your higher tax bracket by paying them and putting it into their lower tax bracket. That's one. Another reason is if your spouse is not on your payroll yet, you can put your spouse on the payroll and then fund retirement with whatever that payroll amount is. And essentially that retirement contribution is tax deductible. So those are the 2 cases where we generally see business owners put family members on the payroll. It's very popular. The one caveat is they have to technically earn the income. So you can't all of a sudden put, aunts and uncles and cousins and spouses and kids on payroll if they're not actually earning the income. So, we have to at least mention that. So but it is an effective tax planning idea. A lot of our clients will just put pictures of their kids on their website in childcare. That's an easy thing to do. And they're essentially a website model, and that's the justification to pay them. So putting your kids on payroll and then funding retirement, a Roth IRA, or a 529 college savings plan is an effective way, an effective use of those funds. Staff bonuses, we talked about that early, just the timing of that, equipment purchases, now with the Section 179 rule that allows you to write off up to $2 million per year in equipment in the year that you buy it. Same with repairs. If you're doing repairs to one of your schools or centers, that typically can be written off, all of it, in the year that you do the repair or the improvement. So these are some effective ideas. And again, timing is important. And then the pass-through entity tax is something new. It's here in New York State, but also 17 other states have adopted it. Essentially, this was the state's approach to kind of countering the cap on the state income tax deduction that the federal government put in place. They maxed it out at $10,000, the itemized deduction. So it hurt a lot of states that have higher income tax like New York and higher real estate tax like New York. If you're a New York resident and you can only write off $10,000 of the New York taxes you pay for real estate and income tax, that hurts you. You're significantly behind from where you were prior to this change. So the states have come out and made this new election that can put more money back in your pocket. I know for New York, the deadline was October 15th to make that election. So that's already come and gone. We worked on that for all of our clients, but every state kind of has their own rules. And if you haven't made this election yet in your state, you should certainly talk to your accountant about considering it. Okay, so those are what I call our general tax suggestions and ideas for planning. Now we're going to get into some real estate and other tax legislation. So with that, we have our next poll.
One second here, John. All right, we've launched the poll. Do you own at least one of the properties for your schools? We know sometimes individuals have only one property, they're leasing it, or they have one property, they're owning it, but they oftentimes can have multiple locations where sometimes they lease and they own. So let's go ahead and we're going to end the poll and launch the results. So sort of the flip on this one, John.
Yeah, that's good. So there's a lot of good tax deductions here. Again, this was that's why that question was out there. So 75% of you actually own the property. That's great. So when we're talking about, diversifying your investments. So if you have a retirement plan and the building and your school, your center, now you have 3 assets that are separate, which is great from an investment standpoint. But let's get into some of the benefits, the tax benefits of owning real estate. So there's a lot of planning opportunities when the business and the property are in the same ownership. Now it gets a little more complicated when your building may have other tenants in it, or your center isn't located in the building that you own. It works best when, say, you have one building and your center's included in it. Then you don't have limitations on how you can deduct the real estate losses. One benefit, there's no self-employment tax. So that's key. If you're a single member LLC business, right now you're paying self-employment tax on all of your income from your center. The real estate, you wouldn't have that. And we would always recommend from a legal standpoint that you separate the real estate and your school into 2 separate entities. They shouldn't be owned by the same entity for liability purposes. So with real estate, you receive depreciation deductions, and that's why we like these for tax planning. So you can write off the cost of the building and any improvements generally over a period of time, but there are effective methods like cost segregation studies that would allow you to write off that investment quicker, right? So depreciation often causes a tax loss, even when you're cash flow positive, why we really like it. And real estate tax losses generally are capped at $25,000 a year. But in a lot of cases, again, where the building and the center are in the same location and there's no other tenants in that building, your deduction can go beyond that $25,000 a year. So you should be looking at your depreciation schedules if you own a building. The good thing is you can actually retroactively go back and change your depreciation through a cost segregation study and recapture deductions you may have missed in the past. We've done a lot of those amendments, and we've helped clients with those studies in order to maximize that deduction.
Hey, John, a question for you about that. Let's say that you owned a property and you sold it. After you sell the property, can you go back after those deductions, or is it sort of foregone at that point?
It's foregone at that point, unfortunately. Because really at that point, it doesn't matter anymore. Whatever deductions you didn't take, you're going to take it against your gain on the building sale when you subsequently sell it. So it wouldn't be worth all the amendments and the cost to amend to untangle all that. All right, so legislation and tax rate. So here is the 2021 personal income tax rate. I'm assuming everyone that owns a business has what we call a flow-through company, which would be an S corp, a partnership, or they're a sole proprietor, and none are really C corps. So these are the personal income tax rates for the married filing joint category. So we have 2021 and 2022. So if you kind of look down here, you can see right now, what the income thresholds are under the current law. So the highest bracket is, again, if nothing changes in legislation, the highest bracket is 37%. And all that changes is the income amount that kicks you into that bracket. So right now for 2021, when your income is $628,300 or higher, you're going to be paying at the highest bracket. For 2022, they just increased that for inflation. It goes up to $647,850. The rest of the brackets are the same, just the income thresholds change. And, 2021 is what it is. That's not going to change. 2022 is where we probably will see some changes. So if we go to the next slide, This is the tax act that's that's not in legislation yet, but is being proposed. So it's the Build Back Better Act. So a key tax rate provision includes an increase in that top bracket that we looked at from 37 to 39.6. This is what the rate was under President Obama, and President Biden, it's not surprising, is looking to put it back to the 39.6. What he also will do is that threshold of 647,850 that puts you in the 37% bracket. Now that top bracket is 450. So if your income is 450 and above, you'd be now in a 39.6% bracket. So if we go back to the old brackets, that 450 before had you in the 35% bracket. So the effective adjustment there is almost 5%. And that's just on the federal side. Then you also have whatever your state's going to do. So you have 5% on $500,000 is a lot of money. It's $25,000. So it depends on where you're at with your income. But ours basically, we're looking at increase in tax rates for next year. And we'd be very surprised if that doesn't happen. The act is right here. It's just not signed yet. The increase in the long-term capital gains rates. Right now, long-term capital gains for certain income, when your income's a certain level, is 20%. That's proposed to go up to 25%. So if you're selling your business, you certainly want to look at closing before this year ends versus waiting until next year. The proposal has that starting on any sales that have occurred effective September 13th. My guess is that date will get pushed out to when the legislation is signed, hopefully. So if you do have a business that you're considering selling, you still have a window to sell it and keep it at 20% or under. But this is a big change. We actually thought this might even go higher. So it is somewhat of a win if it stays at 25 from 20. Estate and trust tax changes. This is big. Right now, everyone has an over $11 million tax exemption for their estate. That's going to drop considerably. Could be a couple million, at least be 5 million or less. So that's a big adjustment that's coming down the pipe. So if you really have to have a good handle on your net worth and what your estate is, and see if you should be doing any shifting or maneuvering of assets to not have an estate tax issue. And then the last item on here is just how the tax planning will affect these changes. You may want to accept because of this. Now, most of our presentation, we've talked about deductions and lowering income. Well, now with these tax rate changes, and that's what makes it more complicated and tax planning so much more important this year, you may actually want to accelerate income this year and move your expenses to next year based on what's coming. So sorry to be the bearer of bad news with this slide.
I think we've all sort of seen it coming, John.
Yep. And it's not surprising. So the last step here is, okay, we have all this information. We have a bunch of ideas now. So how do we turn all these ideas into an actual tax plan? How does this actually work? So with that, we'll go with our last poll question. So we can kind of get an idea of where the audience is as far as tax planning goes. And pretty simple, have you prepared your 2021 tax plan yet?
So let's go ahead and launch the poll. Have you prepared your 2021 tax plan as of yet? Yes, no, but that's why I joined the call. And in the thick of it right now, that you're in the middle of doing it. So as people go ahead, we're getting most people answering, and let's share the offering here. This is what they came back with, John.
Okay, so 75% have not, and that's why you're on the call, and that's great. I figure that's why you're on the call. And that's good news, so that you still have time is the good news. We still have, a month and a half to 2 months to put a plan together. So let's take a look at how that would work. So, a lot of this is straightforward, but step one is having good books and records. You can't prepare a tax plan if your numbers aren't in good order. So the first thing you want to do is make sure your books are reconciled. I'd say through October. We're almost done with October. And then you only have to project 2 months. And that's the important part, is that you're accurately projecting what you think November and December will be like. It'll never be exact, but you want to have an idea. So step one is get your books done through October. Step two is set up a meeting with your CPA. Well, step two is project the rest of the year. Step three, set up a meeting with your CPA to discuss, okay, what are my options here? What we do a lot of if-thens with tax plans. What if I do nothing? What if I fund retirement? What if I sell my business? What if I purchase equipment? What if I buy a vehicle? All the things we talked about earlier. And then again, for this year, you want to compare the impact not only on 21, but also on 22. So this is money that's well spent to determine where you stand for taxes. One idea, one maneuver could save you thousands of dollars. So it's something you shouldn't ignore as you go into the end of the year and then kind of coast into next year and then realize, oh, wow, I could have saved 10, 20, $30,000 if I had done some simple things here. So before year end, execute on the strategies. You know, if you don't have a retirement plan, which we saw most of you don't, then you want to look into setting that up now. Talk to your financial advisor or talk to a financial advisor, talk to your CPA. We offer all those services here. Every situation is unique. So you need cash to do a lot of these things. But like Tony mentioned, which was a great suggestion, using your line of credit, this is one of the times where it could make sense to use your line of credit in order to spend that money on tax deductions. And then just be flexible. Things are going to change here. You have to adjust for changes in tax laws and actuals versus projected and things like that. But this is the first step in preparing a tax plan. We have software where we work with our clients in preparing tax plans so that there's no surprises is really the key there. And we reach out to each client before the year ends to make sure they've considered this. So with that, we can open it up for questions. That's everything we had prepared for today. And I know Rob's been cranking on some questions over here as well.
Yeah. So John, some of the questions that I have when it comes to, and I'll look to see if we have any that come in Q&A, but just to ask you some questions as well as obviously Rob, who's helping out in the background there too. But when you do look at typically tax planning, just from a higher level perspective, there's always been for us a little bit of a hurry up and wait. What do you recommend, like to your clients? What do you tend to recommend? Like, in other words, how do you plan it every year? When should they actually start doing a tax plan? When should they feel like they should be done by?
I think so. If you started it much before now, you probably started it too early. So, because you never know what's going to happen in the last 3 months of the year. So, especially these types of years we've had, there's been very different types of years. So I would suggest that you wait until October closes, and now you only need to project 2 months, which should be a lot easier than if you have to project 3, 4, or 5 months. Some of our clients want to get started like mid-year. It's just way too early because you're not sure what's going to happen the rest of the year. The other impact that we didn't touch on yet is how the stimulus money you may have received between a PPP loan and other grants and the ERC credit and all that. Those have tax implications. The PPP is not taxable. The ERC is. Most grants are taxable as well. So you have to include that in your tax plan. But I would say once you close your October books, would be the best time to start.
So, and that speaks, and I do see that we had a question come in too that I think Rob is answering online for Barbara. But when you look at that, because of a number of us have taken PPP, a few of us have taken ERC from previous workshops that we've done here, webinars. With the ERC, those are some pretty big numbers that have come back out of it. And it's a little bit of a clawback, I guess you would say, by the federal government saying, well, I know we're giving you this money, but we're taking some of it back. Is there any particular strategies you can to hold on more of it? Or does that just come down to your total taxable income and the strategy you talked in the first, quarter of this presentation?
Yeah, it kind of just depends on what tax bracket you're in. But if an effective way to utilize those funds is those funds come in, and let's say you didn't have a retirement plan like most on this call, well, that would be a good use of some of that money, is to set up a retirement plan, assuming you have that money available. Now, that money was really put in place to cover payroll expenses that you couldn't cover because of COVID, because your income was down. However, if somehow you end up with those dollars and you still have them because your business picked back up, then you'd want to implement these other strategies. So you're taking that in as income, but you're spending it right back out on a retirement plan that makes it a deduction, and your taxes don't change.
Yeah, that's good. One of the other areas is many of the states, because of the $50 billion stimulus package within, I believe, the CARES Act or CARES Act 2, came through to childcare through the state. Some states are handing it out in lump sums. Some states are handing out these and sort of like drizzling it out slow and over time. When you do receive these grants, for the most part, I know we're looking at all different states, so it's hard to go across every state. But is there any rules of thumb when you are taking these funds? Should you consider putting some of these funds away when you're receiving them, for the fact of having to look at your quarterly tax payments and things of that nature? Or what might be the best way when you think about as you get these funds? Because these funds may continue into 2022 also.
Yeah, I think good practice whenever you have any sort of income is that you reserve, say, 30% of it for taxes. That's
Okay.
just smart. Unless you're specifically using that money for retirement, or like Barbara asked about the vehicle question, or to purchase a vehicle where you're just offsetting it somewhere else and it won't be taxable. But good practice is to set, have a reserve there, because the last thing you want is a surprising tax bill. I just talked to a prospect the other day that had a $140,000 tax bill and wasn't expecting it. Those are the worst conversations a CPA could ever have with their client.
Yeah.
There's no way to sugarcoat that as smooth as some of us can be sometimes.
And, one of the other areas too is a number of schools this year may, because of PPP, because of ERC, because of different grants, receive more income than they normally would have normally got. So they may be facing a pretty steep tax bill come early 2022. What are your thoughts about replacing or upgrading or adding capital goods to your schools, whether you're putting in new kitchens or new furniture or doing capital improvements to your school? What are your thoughts of approaching that at this point in time of the year?
I think it's a great idea. I mean, right now, the leasehold improvement deduction lets you write that all off immediately. That was a Trump tax change that is significant. Usually you'd have to depreciate those expenditures over 15 years. And outside of taxes, you always want to make your center relevant and fresh and new and exciting. So yeah, you don't want it to ever get stale where you start to lose, some of your families because you're not, upkeeping your location.
Okay, so yeah, so definitely doing stuff like going through, putting new flooring or carpeting in, going in and maybe rearranging some of the rooms, redesigning some of it, or actually just updating and refreshing all of your furniture. I just think is something that we're looking to do, because I went through some of my schools and I was like, we're getting a little aged on some of those things. It'd be nice to bring in some nice new wood furniture in there. So I think we're gonna try to do that before the end of the year.
I would say, it goes without saying, we did a lot of these webinars during COVID, in the height of COVID when all the stimulus started to come out. We've never seen this level of stimulus in our careers, and we may never see it again. Hopefully we don't. So there are a lot of dollars out there that have been handed out, that you really want to be smart on how you're using them, because when the dust settles, you're not going to have those dollars anymore. And it's just going to be you and your business, and it has to stand on its own. And we've seen a lot of clients kind of rely on all this funding that's out there. And we're just cautioning them to not fall into that trap of expecting this money, after this year. So,
Yeah.
you
You
know,
know, that's a really good point, John, because what happens is we sort of get, to use a term we hear lately, gaslit into believing that this kind of funding will come and save the day for us. And it likely won't, like you say, be there. So if you can take advantage of it now to put yourself in a rock solid position for the future, you're definitely doing yourself a huge benefit. And that sort of leads us into the fact that, we're at the end of our time here, but the next time you're going to be joining us on December 9th is going to be for one where we're talking about succession planning. And when we talk about succession planning, for those of you out there, it's not really about just selling your business. It's just preparing your finances to look at if one day you were to transition from your business. And that doesn't mean you have to sell it. It could be that, but you might hand it over to a family member. You might want to be just a partial owner. There's a number of different things. So why don't you come back and join us on December 9th when John will be here to talk about that again. And the first end of that, and that he's talking about the finance side of it and the business side of it, Kathy Ligon will be here next week, actually on the 2nd. So if you want to join us again. So John, I want to thank you so much for joining us again for, I think, what is a very important one. And I know that we're going to do another one of these again next year around tax planning season again. But thanks so much for all your input on this. This has been great. And for those of you who are saying, hey, listen, it would be great to have a partner like John and team, just reach out to us. We'll put you in touch. A bunch of our members have joined forces with John and their team. And I think they're seeing some really great results because of it. So John, thank you very much.
thanks, Tony. And thanks everyone for your time and your attention.
All right. Take care, everybody. Another great session with our business benchmarking series. This is Tony D'Agostino with Inspire Care 360. We look forward to seeing you again in the near future. Have a fantastic week. Take care, everybody.